Rivian announced the R2 today and actually surprised a lot of people in announcing the R3 as well. The stock is up double digits during the day. I think there was a lot of excitement, not only about the new products, but the bigger thing was a bunch of cost reductions associated with delaying the Georgia plant and moving R2 production to the Normal, Illinois plant. Now, the short-term reaction from the market was obviously positive, but let's be really honest. If there was enough demand for the R1 vehicle, for a $70,000 plus vehicle, to fill production at the Normal, Illinois facility, they would not be moving R2 there. So you're seeing that there's a demand problem. Secondly, the overall capacity now for Rivian is going to be 215,000 vehicles. That's down from an estimated 500,000 to 600,000 vehicles once the Georgia facility was built. So now it's going to be much harder for the company to get to profitability. And this is fundamentally the challenge for Rivian right now. I did a video recently that walked through why the company is walking a real tightrope from a financial perspective, just getting to the point where they can launch the R2 vehicle. And now they're really showing that even if they launch R2 on time, sometime in the first half of 2026, they're going to probably still losing money even after that product is launched. So I'm going to dig into some of the numbers today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So I'm going to go directly to the release that Rivian put out today. I'm not going to focus too much on R2 and R3. If you want to see reviews of the vehicle, there are plenty of those available, but I'm focused on the investment side. So let's look at what was announced from a capital expenditure standpoint. This is the part that I want to focus on in this video, is what management announced related to improved capital efficiency, $2.25 billion worth of savings, as opposed to original forecasts of launching the first line of R2 production at Rivian's Georgia site. Management does say that cash equivalents, and short-term investments are expected to be sufficient to fund operations through the start of R2 production. I think that's really key because you can do some simple math and get to 2026, a quarter or two into 2026. It's really hard to get past that. And here's the key that I really want to focus on. Total expected normal capacity following the R2 launch is expected to be 215,000 vehicles for R1T, R1S, EDV, RCV, and R2. So these are all of the vehicles. There's going to be 215,000 units of capacity. I'm going to just pull up some of the numbers that I used in a video recently. This is just some simple estimates that I put together for where Rivian's cash position is today, or the end of 2023, $9.4 billion worth of cash. They're expecting $2.7 billion of negative adjusted EBITDA in 2024. So the estimate I put here was $3 billion in negative cash from operations. Lower that a little bit in 2025. Maybe they increase production for R1 vehicles or EDVs. Maybe some of the cost reductions that they're putting in place are effective. And then I had the Georgia plant, $5 billion estimated there. And if you add all those things together, by the end of 2025, you get to a negative cash balance of about $600 million. Now, take into effect the cost savings that they announced today, $2.25 billion. Now you get to a positive cash balance of about 1.65, let's call it $1.75 billion at about the time of the R1 launch. That's how you get to the point where Rivian has enough cash to launch R2. But here's the problem. When they launch R2, they're only going to have 215,000 units of capacity. To increase that capacity to 400,000, 500,000 units, you're going to have to spend that $2.5 billion to build the Georgia facility, what they're putting off right now. And this is where the math gets even harder. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This is a look at Rivian's operating costs. And these operating costs have been pretty consistent for 3 years now, about $3.7 billion per year in operating costs. This includes R&D, it includes sales and marketing, all of the costs that go into running a business like this. Now, some of these costs could potentially be reduced long-term as you move some of these costs from operating to part of production costs or sales costs that would fall into gross margin. But if we just use this number and divide it by the 215,000 units that Rivian says that they're going to have capacity for when R2 launches, to break even on an operating perspective, Rivian is going to have to generate a profit of $17,209 per vehicle sold. So the gross profit is going to have to be $17,000 per vehicle to break even on the operating profit line. To put that into perspective, if Rivian was able to generate a 25% gross margin, which is the highest we've really ever seen an auto company generate, even for a short period of time, this is also nowhere near where Tesla is operating right now. They would have to generate almost $70,000 per vehicle. What is the R2 selling for? Well, it's going to start at $45,000 per vehicle. So this is the fundamental problem that Rivian and a lot of electric vehicle companies are going to go through. There is more demand for vehicles as prices go lower. That's obviously clear. But your profit per vehicle is going to go lower as those prices go lower. So now you have to get to the point where you scale your supply, where you're building more manufacturing plants. This was that 5 year or so point where Tesla was trying to increase their production of Model 3 and Model Y, building plants not only in the US, but also in Germany and China. And that's how they finally got to profitability. That profitability wasn't as sustainable at a 25% gross margin as they maybe thought it was going to be, but they at least got to profitability. Rivian is not at the point where they have profitability even in sight. There is no sign that this company can generate anywhere near a 25% gross margin on a $70,000 vehicle, much less a $45,000 vehicle. So I think the truth is Rivian has said everything that they need to say with this announcement. Yes, the R2 has been announced. Yes, the R3 has been announced. But what they said that was even more important than that was that capacity was going to be limited to 215,000 units. And it is going to be nearly impossible for them to generate a profit with that level of production. That's just the reality of the business. It's the reality of the auto business. And in the meantime, in getting to that point where they're actually launching 215,000 units, they're going to burn through almost all of their cash. So this is the tightrope that Rivian is walking. This is the very, very difficult financial position that they're in. I don't think this is an investable company because if they had demand for all of these vehicles, they wouldn't be delaying that Georgia plant. They would be finding ways to finance that plant because they need to make vehicles as fast as they possibly can. But that's not what we see. That's not what they're doing. I actually think the best case scenario for Rivian now is to eventually find a buyer for the company. And maybe that's what they're doing. Maybe they're trying to position themselves to not have quite so much overhead and capacity. If another one of the big automakers comes in and tries to buy the company, they're probably not going to want that Georgia facility, but they are going to want a full lineup of R1, R2, R3, the electric vans. Maybe that's something that would be more attractive in a more efficient manufacturing facility in Normal, Illinois. So that could absolutely be something that management is considering because honestly, I think that's the best alternative for the company because it has less ability to raise billions and billions of dollars worth of capital than it did even just a few months ago. So as excited as the market is today, I think this news was actually about the worst thing that you could hear from Rivian because they're admitting that the upside is going to be nowhere near where we thought it was even just a few months ago. But what do you think about Rivian's announcement? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.